Welcome back, folks. We have the Dow Industrials right now up 44, NADEX up 19, S&Ps are up 9.5. And Wednesday, we got oil numbers, and oil itself, we love these volatility trades, but bottom line, folks, is this is going to be really intriguing here, watching how this thing shakes out after yesterday.
And I don't think anything can live up to yesterday's volatility, man. If it does,
$2.50 move in 10 minutes, 7 minutes.
Just to look at it real quick, right? I mean, so we were on the air from 10 till 11 yesterday. Just to back up, there's our chart from 10 to 11. We're trading just under $70. We get off the air, and then 11:05 news begins to break on the possible Iran deal, and oil trades from 68.50, call it, down to literally 66.50. Excuse me, yeah, 66.50, 68.50. Is that right? I'm all over the place. 67.60. Yeah, so $2 from 69.60 to 67.60. The span of 10-15 minutes, and then before you know it, it's back above those levels. So we're sitting at 71.01. It's 10, call it 10:20 right now. We get the EIA numbers coming out at 10:30 a.m. Eastern time every Wednesday. So I started jumping around. Let's look at potentially setting up a similar volatility trade, right? Exposure in both directions, looking for those inventory numbers coming out at 10:30. So I pulled up the 11 a.m. spreads. These are the spreads that expire at 11 a.m. They go from 9 to 11 Eastern time. So if we wanted to have bullish and bearish spreads, we're buying the bullish, selling the bearish, looking for volatility. $70.75 is going to be an option for a price that we can use for. That would be a kind of our pivot, as in have an exposure upside from there, have an exposure downside from there.
Not bad. We're at $70.99. Okay.
Yeah, so we'd have 25 cents almost of intrinsic value to the upside. That's where it's going to be a little bit costly, though, when you add that. So just the positive spread alone is going to be $36 because you're adding the $25 of intrinsic value plus 12 cents in premium. And then on the bearish side, you're out of the money, so you're just paying the premium, which is 12, 13. So you're looking at $49, or which would be about 49 pennies away from 70, 75. Becomes your break even. Let's jump to the 12s. So the 12s, what's interesting is they're going to line up a little bit. No, excuse me, same exact, right? 70, 75. Okay. So here's our exact same spread, except an extra hour. So on the 11 a.m.s, the bullish one was costing us, call it 71.08, right? It was costing us about $33. And you can see the difference between the bid offer here with them side by side. And all that's happening is this noon one is giving you an extra hour. So that's what you're paying for, right? So again, the 11 a.m.s were going to cost us, what was it, like $49.
Yeah.
So we'll close those out to avoid confusion. Here's our bullish spread for noon. We're going to pull up the same bearish spread. Again, same exact $1.50 exposure you have. And so for noon, we're going to be looking at 61. Okay, so you're adding about $5 or 5 to 6 pennies on each leg, it looks like,
on
right?
Each leg. Yeah, right.
And guess what? The market's probably pricing this a little bit more premium than usual.
Yeah.
Because when you're getting this type of volatility, they're not going to give you a defined risk trade by putting nothing up, right? As in the market's reacting to the volatility in oil, and the premiums might be a little bit higher than they have been recently. So that's your noon trade. Now, what's also happening, though, is that we have quite a head start, and this is moving. And it's moved down about 8 pennies since we started looking at it. But you have quite a head start to the positive side, as in, if you want to break even, even on the noon trade where we're looking for 60 to 65 cents of action, it's a lot easier to break even to the positive side when you have almost a 25-cent head start to the positive side. So let's just jump in and see what kind of other options being our choices. So here's where things get interesting. So you go to the dailies. Now this is where you get 71 for your point. Okay. Now we were at 71 when we started doing this. We're now about 8 pennies under.
That's right. So the 11 and the noon is 70, 75. Now we're going to deal with the 71.
Exactly. So the difference being that instead of having about 20 to 25 cents of intrinsic value to the positive side, we're now going to have about 8 pennies to the bearish side in these trades. But what you're going to see is that we only have to pay for that intrinsic value for 8 pennies as opposed to paying the 20. So here's our bullish spread. Now we have $3 as opposed to $1.50, which is a little bit different as well. Like we saw yesterday, $3 is not out of the realm. So here's our bullish spread. This one's going to be the one that's out of the money, so only premium. And we're looking for about $32 is what we're paying there. And then again, we're going to pull up the bearish spread. So same pivot point, $71. Going to be bearish. And this is the one that's going to have about 10 pennies of intrinsic value. So that's costing us about $74. Okay? $74. Again, the difference there, though, is that we have until 2:30 as opposed to until 11 or 12. And you have $3 if oil really gets rocking. And the reason why that this isn't much more expensive than the noon is because of that intrinsic value. This is closer, as in we're only 8 pennies away from this $71 point, which is where our volatility goes from, as in our max loss is going to be at $71 in this position, right? Because then they'd both kind of expire at, you know, the floor of your bullish spread, the ceiling of your bearish spread. You'd have no value at $71, and when we're really close to it, the only intrinsic value right now is in this bearish spread of 8 pennies, as opposed to having to pay 20 to 25 cents of intrinsic value in the 11s or 12s.
You know what's pretty cool about this, too, is that, you know, the volatility trades, folks, you're just looking for volatility. And if you do have a bias one way or the other, you have a couple of different choices here, which are pretty cool.
It's a great point, definitely. You know, I was talking to some traders yesterday about just the trades we were talking about, and they kind of said the same thing about the trades we were looking at yesterday, because they were great volatility trades, but you could have been directionally biased in one way or the other, and man, what a trade that ended up to be if you were bearish. Or if, you know, you had seen that spike down to $68 and you decided to take a bullish position and you got the rebound back up to 70 by 2 o'clock.
Crazy.
Yeah, so, you know, either way, right, you're 5 pennies away from $71, and we focus on both of these contracts, but yeah, if you're bullish, boom, there's your $33 cost, okay? If you're bearish, there's your $39. The only difference being the 6 pennies of intrinsic value you're paying for the negative spread, because guess what? You have that value if it expires right where it's at right now.
And you know, the numbers that come out last night, there was a big drawdown in distilled. Distilled
for
was like
API?
6.7 million barrels.
Interesting.
You know, and what that is, you know, distilled, folks, was heating oil as well as jet fuel. So it's like you don't know which one is going to. I mean, I guess we dig into it, we could, but bottom line is that is a big number. You know, that's
pretty remarkable. $71 oil. We were just at $68 less than 24 hours ago. You got some geopolitical risk in there for sure. But it'll be interesting to see how the market reacts to this with such an underlying geopolitical situation going on. As in, you know, we're talking to our man Kevin Hinks yesterday, and we were just saying, you know, is the EIA going to be as big as it normally is in a week, where it might not be as big of a deciding factor in the price of oil?
They might have already just bought it last night and said, okay,
you know,
we're going higher.
And as long as there's not a mammoth surprise there, right? I mean, it might not be the market might not react to it in too dramatic of a fashion, considering that there are other issues that might be more of a driving force. Now, the other side of these, we always talk about, you know, the ability to be looking for volatility. You could be the person selling volatility here in the same essence, you know, in terms of we're buying the bullish spread. You can be the person selling the bullish spread, right? So you're taking in $31 on the positive side. You could be the person buying the bearish spread. You're taking in $37, so you would be taking in $68. And basically, that's your max profit in that position, right? And then your goal is that it expires as close to 71 as possible. So there's a million different ways if you think the volatility's out of it yesterday, right?
That's a huge point, man. We got to start looking at it.
Especially because you have a tight bid offer spread, right? So it's not like you can trade out of these if it starts moving against you.
So dramatically.
Definitely.
Stay right there, folks. Tommy and I are coming right back. Our phone number is 877-927-6648. We have the...
We'll be right back with those oil numbers in 3 minutes, folks.
Welcome back, folks. We have the Dow up 31, NASDAQ up 12, S&P's up 8.5, and what do we got with oil here?
We got the headline number coming in. So you have crude oil inventories falling 2.2 million barrels. Gas inventories falling 2.17 million barrels. Let's jump over back to the NADEX platform, check out how the market is reacting to that number. Quite a little boost here. So we were trading just under $71, right? We're trading about $70.92 prior to that news. We're getting a little bit of a bid as we speak, trading $71.22. So again, remember, a few of these different trades. You had the 11 AMs and the 12s. Those were lining up with $70.75, kind of being our pivot point, where we had profitability anywhere away from that point. And we had a head start to the upside. So this type of action, if you were to trade the 11s or the 12s looking for volatility,
both in the
that would have been a move in the right direction. And then, you know, the daily, the 230 had 71, which we were pretty close to. When we started analyzing the trade, we were kind of right at $71. We were about 8 pennies below that by the time 1030 rolled around. So 22 pennies, but like we always talk about, the first move is not always the move that carries through in this. So we'll check back in, but a little bit of a market upside reaction, and we'll check back in on some of those numbers as well. There we go. I wanted to get the full breakdown. So the estimate was for an increase of 1 million barrels.
Wow.
We had a decline of 2.2.
Yeah.
That's why you're getting a thrust upward immediately, right?
Yeah.
But they dig in. I mean, there's so many numbers in this EIA number that comes out every Wednesday at 10:30 Eastern Time. So Cushing crude plus 1.3 million barrels. PADD 3 crude, a decline of 2.5 million barrels. Gasoline was estimated about 0, decline of 2.2 million barrels. Distillate, estimate was decline of 1.5, ended up being a decline of 3.7 million.
We're drawing down oil.
Yeah.
That's the bottom line.
Fuel demand rising almost 1% in the past four weeks.
And they say that, May 30th is the beginning of driving season, right, for the summer.
Yes.
We go more places. We basically take more trips.
Definitely,
Yeah.
right. So check back in one more. It would always move so quickly. I want to check back every 15 seconds right after that news comes out. So $71, getting a bid of about 20 pennies. We'll check back in.
Pretty wild, man.
Yeah. So let's check back in on the oil price. See what's happening.
Look at that.
So quite a little decline, right? We got an initial spike higher. It's always interesting following these on Wednesday in terms of the moves we get in both directions. So we were trading just under $71 before the news came out. We had the decline of about 2.2 million barrels. Oil spikes to a high of 71.27, and we're now about 50 cents below that level, trading at 70.82. So we'll see how it shakes out.
Well, and what's intriguing there is the aspect of which you had brought up at the end of that conversation.
Yes.
About you could flip that and take the premium in on the other side.
Selling the volatility, right?
Right.
I mean, we normally go over the examples of maybe buying the volatility. It looked like there might have been a little bit more premium than normally.
Right.
Rightfully so, probably.
That's right.
And so, you could go directionally one way or the other we talked about, or you could be the one selling the volatility.
Right.
We're usually looking at buying it, but when you're selling the volatility, we talked about you would have been taking in somewhere around, was it like $55, $60 for both sides of that? So basically that becomes your max profit.
Right.
And then your max profit being if it expires, right, at $71.
Yeah.
So you would have taken in about $60, which represents 60 cents. And then basically every penny away from $71 is taken away from that, right?
Right.
That's kind of a loss off of the value you gained when you initiated that position.
Exactly. And as Tommy just said, it seemed that there was definitely a little more premium inside that today, which is important, and that's what it's all about when you are trading to find risk in the option market.
Yeah.
That you can take that choice. Like, okay, do you think the premium is worth the risk at this particular point?
Right. What's the market assigning the premium, right? And then you get to decide, do I think that's undervalued? Do I think that's overvalued?
Right.
If it's undervalued, maybe you're going to be the one buying the premium, paying for the premium because they're not putting enough premium in there. So I'm going to be paying. Well, they're putting a lot of premium in today. Well, you know what? I'm not maybe looking for a huge, maybe oil ran out of steam with all that action yesterday.
And it did.
Yeah.
It's tired, man. It was
is.
working out all night long. It's been working out for 24 hours.
24 hours, man, right?
It needs a nap.
Those oil traders, man, they didn't sleep yesterday. I don't think they slept last night. I wouldn't have if I was an oil trader.